Welcome, folks, to the unstoppable bull market, the AI bubble, dare I say, and my plans within it and where I think we're actually heading, because the S&P 500 every damn week is hitting new all-time highs. Just today, new all-time high. This week, we're up 2.2%. We are up almost 18 damn percent over a 6-month span. Absolutely jaw-dropping, unimaginable, and just glad that I consistently have been buying stocks, especially some growth stocks, in this kind of market. So we're going to break this down because we just listened to Jerome Powell. If you didn't hear the news, he's not cutting interest rates yet, which is not that unexpected. I mean, we all knew it'd be data dependent. We all knew that it wouldn't be likely we'd see real interest rate cuts probably till the end of summer or fall. At least that was my predictions. People got a little overhyped, a little too early on, probably listening to the Canadian markets, because Canada's been playing in the 2% inflation range now since 2024. The Bank of Canada is in a position to start cutting interest rates, so they are, right? And in the US, we're still trading at above 3%. So if we get into the June data, actually comes into the 2% range, which Jerome Powell has been hinting that we are obviously heading in that right direction. But if you watch that meeting, people were pounding the table, begging Jerome, please cut interest rates. We need it. You're stifling growth and innovation. If you're a younger lad trying to buy real estate, those prices really haven't come down much, but the cost of owning a home now has gone insanely through the roof. If you're venture capital, if you're a small cap company, you need employees, you need to raise money. It is harder than it has ever been. That's why most of the market, when it comes to infrastructure and small cap plays, have been getting devastated. Real estate investment trusts don't even get me started. So what does this kind of narrow down to in my plan looking forward from an investing standpoint? Because we are heading into what I would define as somewhat of a bubbly or bubblish territory. Like, we are on a trajectory that is clearly unsustainable if we don't get a period of breath and have earnings start to catch up and justify some of these absurd values. So we're going to come back to my portfolio here to discuss where I'm at, where I want to be in the future, and at least in the 1 to 3 year plan. Because when I look at companies like Apple that have absolutely no revenue growth, we're starting to pull forward the idea of revenue from innovation like AI. We're expecting that AI is going to lead to a whole new boom in phone purchasing, which I don't think makes sense, because most people aren't buying phones and laptops because the world is too expensive. Just because you implemented AI doesn't mean I'm going to be needing a brand new phone, right? But yeah, we're justifying that that's what's going to happen. I mean, at a 35 times multiple with very minimal revenue growth, we'll see what happens. Microsoft, good example. Unless OpenAI comes public, we justify ChatGPT's value here. We're trading at a hefty premium of 40 times multiple right now, when the 40 times is higher than it has been through most of Microsoft's history. Even at the peak of 2021, when things were still good, man, we're talking about 35 times multiple, even though their net income is still lower than where it was during 2021. And heck, it's probably more at par with 2019 like levels. It's hard to justify, right? Look at revenue growth here. Revenue is below where it was in 2020 and at the peak of 2021, yet we're trading at way higher levels of valuation. Is this justifiable? We don't really know, but historically, 9 times out of 10, no, it's not. I mean, for AI and all these innovations that we've seen come in ebb and flow, it usually gets a little overhyped, followed by a correctional period. I think we're going to see that with companies like NVIDIA at some point. Nobody really knows when. I'm not chasing it, but I am looking to chase the trend that is AI. I mean, that's what we're all kind of doing at the moment. Even if you're buying the S&P, the only thing benefiting you is those Magnificent Seven companies that have really made up for the lower weight of stocks that have virtually done absolutely nothing. Now, I want to talk about valuation for a minute and then talk about the overall plan, because as it stands right now, I think the NASDAQ, I think the S&P, they're heading into overvalued territory. To some extent, I think it is just. I think we're going to see a technological boom across all industries over the next 10, 20, 30 years. However, we cannot be pulling forward so much revenue without justifying it. So this earnings period is going to be highly critical, with the NASDAQ trading at a 32 times multiple, which is well above where it's traded any time basically within the last 20 years, with a few exceptions. The S&P, however, trading at 29 times multiple, I can justify a little bit. Again, I think trading around a 20 to 30 is going to be the new norm, just because of the margin expansion, innovation, and what software is bringing to society. But again, if we keep going up the way we're going up, it is an unsustainable growth period. Every single day, the price to earnings multiple is going up with the market, right? It's crazy. And the NASDAQ isn't a good justification. You want to pay more attention to the Qs, because the Qs obviously represent those Magnificent Seven-like companies that have been giving these absolutely absurd gains, with a few exceptions of the interest rate cycle that we saw through 2020, the crash of 2020 with the pandemic, and then leading into the interest rate, raise cycle. We've still survived all of that. That's how resilient these technology companies are. But I think you're missing the bigger picture, right? Because right now I'm playing this trend with this AI stuff, especially when it comes to Tesla and Google. I took some profits on Google. I'm looking at Tesla, but there's only catalysts that have no justification to the bottom bottom line that are driving this growth. I mean, with Tesla specifically, right? What do we have? We have earnings coming up. They're not going to be great. We also have AI Day when it comes to the launch of their self-driving taxi, the low-end cost vehicle. They're going to be mass production vehicle, as they've so called it. And those catalysts can really drive the stock up, but it's pulling forward as though those things are generating revenue today and that they're generating significant revenue. So I'm not going to like pay for something that I don't see happening for the next at least 2 to 5 years, but it's valued as though it's happened today, right? That's what you have to understand is going on with a lot of stocks today. And you got to play that trend to whatever your comfort level is, because I can't tell you. Like, I can only show you what I'm doing, and I could be horrifically wrong. But if Tesla runs into the 300s right now, I think that value is unjust, and I'll likely start taking profit on the position. My long-term plan in the next 1 to 3 years, however, is to start shifting more into the asset recoveries, or the asset recovery plays that have to do with interest rates, right? Your dividend stocks. At the end of the game, I've always been a conservative investor for the most part. In my heart, that's how I feel anyways, and I'd like to have a 50-50 split of the S&P 500 and a variety of dividend plays. And I'm really hoping what we see happen is that, you know, these stocks continue to run in an aggressive manner, that I can slowly start scaling back on, and I can start leaving that cash to position into some more dividend-oriented ETFs that'll benefit greatly from a lower interest rate environment. I mean, those people that thought the recovery plays were coming really quick, I mean, that's like SCHD, right? Like, I see SCHD as a recovery play. I don't see it as a stock that has any reason to rally because so many companies in there are infrastructure, they're real estate oriented, you know, they're just companies that are struggling in this market, right? The lower half of the S&P. And I feel like it'll just equal weight the portfolio a little bit more when I start buying more Canadian ETFs that pay higher yields. And I'm hoping that over time we'll start to see those recover, because the best, fast track retirement plan I have is keep taking wicked profits here, and then hope once we start seeing interest rates come down a bit more in the next year, really start orienting money and capital toward that direction to hopefully see a little bit more accelerated growth than we have seen with a lot of these telecom giants and energy companies and utility companies that have just been getting slaughtered in this market, right? But who knows? Time will tell. We're going to kind of play it by ear, but my general plan is to just feel it out. You know, we'll see how it goes. But for now, at least we caught somewhat of this train with Tesla and Google in the S&P that continues to go up at an exuberated level. And like I said, this is just fascinating to watch. And I would love to know what you guys are doing about it, because like I said, it's crazy. This is what a bull market / bubbly new industry looks like. Saw it with crypto, we saw it with MJ Markets, we see it time and time again. Go watch my live stream on Sunday where I point out how much things change over a decade. Like, if you look at the top performing, the top talked about highest growth stocks from 1990, 2000, 2010, they're non-existent today. So just be aware of that when you're looking at companies like Tesla and Palantir and Nvidia, that a decade can really change a lot. There are very few exceptions where companies actually outperformed the decade later. But I'll pass that off to you. I'd love to know what you think in that comment section below.